Hey everybody, Smart Silver Stacker here. Hope you're doing well. So that was a very interesting week in the markets that we just concluded, wasn't it? We started off the week all eyes on Jerome Powell and his testimony before Congress for the Fed's semi-annual monetary policy report, and then everyone was anticipating the jobs report on Friday, the non-farm payroll from the Bureau of Labor Statistics. I know I was, but we finished the week up being concerned about a systemic collapse of the US banking system. So, how's that for escalating quickly? And in today's video, I want to dig a bit into the collapse of SVB, that's Silicone Valley Bank, and the implications that this has for gold and silver, because it was very notable, gold and silver's reaction to this news. Now, if you've been watching the videos I've been putting out for the past week or so, you know I was forecasting that we might actually see a bit of a sell-off in the precious metals if we got a better than expected jobs number on Friday. And we did get the better than expected jobs number, beat expectations by, I think, about 100,000 jobs. But gold and silver did not have the reaction that I anticipated. They really shrugged off that news completely, and they had a pretty nice rally. Now, it wasn't markets across the board that were in the green. Markets across the board were selling off, but gold and silver were notable exceptions. Now, this is a very interesting development that I think has some very significant implications for gold and silver moving forward. Now, speaking of gold and silver, today's video is brought to us by SD Bullion. You can check them out at sdbullion.com/new, where you can get your first purchase of gold and silver bullion at spot. Now, why was the reaction of gold and silver so interesting? Well, one thing that we have seen is for several months now, going back, anytime we get any positive economic news, so better jobs numbers, or anytime we get higher inflation, so a hot CPI report, one thing we see is that the precious metals sell off, and pretty much markets across the board do. And the reason for this has to do with the anticipation of how tight the Federal Reserve is going to get in their attempt to fight inflation. How high are they going to raise interest rates moving forward? Now, if we start to see risk to the banking sector, for example, SVB collapsing, we're going to talk about that in detail here in just a moment, it's very interesting that gold and silver start to rally, because what this tells me is now markets are no longer concerned about how tight the Fed might get. They're concerned that there could be a crisis coming, that the Fed is going to be forced to react to. Now, is the collapse of SVB going to be the excuse that the Fed needs to pivot and to stop their program of interest rates and to return to the printing presses? Well, I don't think SVB collapsing is going to be enough to do that, but there is a real possibility that this contagion could spread to the rest of the banking sector. Now, let's talk about what actually happened at SVB. Well, SVB is a bank that catered to startup companies, and the startups who were their customers were burning through an unexpectedly large amount of cash, and so they were not making the deposits that SVB expected. In fact, some of them were withdrawing funds, and as a result, SVB was forced to liquidate a portion of its portfolio of assets, and those included a big chunk of US treasuries that were purchased back when interest rates were lower. Now, with bonds, with treasuries, the way that the pricing of those works is that if the interest rate on bonds, if the yield increases, then the value of existing bonds decreases, because it has to in order to compensate for the higher yield that the new issues of the bond are providing. So if you are forced to sell one of these bonds after interest rates have gone up, you take a loss, and SVB took about a $1.8 billion loss. Now, I know I talked about this in yesterday's video that I put out in the morning, but more information has come to light. I have had the opportunity to learn a bit more about this, so I want to dig a little bit more into what happened and talk about why this could threaten the remainder of the banking system. Now, the damage control narrative that you're going to hear about SVB is that these are idiosyncratic events. They're related only to SVB because of SVB's clientele, startup companies. It's riskier than the depositors in a lot of other banks. Other banks aren't, their clients aren't withdrawing funds the way that the clients of SVB were. Other banks across the system, they have the same problem that SVB had, the inherent problem, and that is that they're carrying a bunch of treasuries on their books which have an unrealized loss. A lot of these banks bought up this government paper when yields were low, and so what they're trying to do is hold these bonds to maturity. So if they bought up a 10-year treasury, they just are going to hold it for 10 years and then get their principal back when the bond matures. But the problem is, if they are forced to sell, like SVB, then they're going to have to realize these losses too. Now, one thing you might hear is depositors in these other banks, they're not going to be withdrawing their funds because they don't have the motivation to. They're not startups who are burning through cash, so we won't see that. But I think that the mere fact that SVB collapsed might be enough for depositors in these other smaller banks to begin withdrawing their funds. Now let's talk about the small bank thing, because SVB is not a tiny institution by any means, or it wasn't a tiny institution. It's the 18th, or was the 18th largest bank in the United States. And it's also the second largest bank to fail in history. The biggest was Washington Mutual, based out of Seattle in the 2008 financial crisis. But this is the biggest failure since then and the second biggest one on record. So this is not a small development by any means. SVB had something like $175 billion in deposits, and a large portion of it, I believe $125 billion, was uninsured by the FDIC. So the FDIC is the insurance on U.S. bank deposits, and that insurance goes up to $250,000. So it covers the first $250,000 of a deposit. But beyond that, I believe the situation now is that the bank, the SVB, has gone into receivership. The FDIC has taken possession of it. Now, if you had a smaller account there, $250,000 or less, ostensibly you'll be made whole by the FDIC. But other than that, if you held, say, $1 million in there, well, that $750,000 that's above the insurance, you're probably only going to see a portion of that, and it might take a while for the receiver, the FDIC, that is, to liquidate the assets of SVB and distribute them to shareholders. So you're going to be getting, cents on the dollar, and who knows how much, but there will be billions of dollars lost. That's almost for sure. Now, what triggered this really was on Thursday when Wednesday night, the announcement was made that these bonds had been sold and SVB was going to take this $1.8 billion loss. On Thursday, a huge bank run began where something like $42 billion was taken out of the bank, one of the biggest bank runs in history in sheer volume. This caused the share value to plummet. On Friday, it plummeted even further. It was 60% on Thursday, then another 60% hit in pre-market trading on Friday, and trading was halted and the bank was closed and it went into receivership. Now, the risk here is that if deposit holders, the clientele of other banks kind of in the same situation as SVB, if you've got $1 million in one of these smaller banks that you think might be vulnerable, well, you're probably going to take that out on Monday and put it into a larger bank where the risk may be mitigated to some extent. So you take out your $1 million from small bank A and you move it into a Wells Fargo account or something like that. And if too much of this happens, we could see a cascading collapse among these small to mid-sized banks in the US. And so far, Bank of America, Wells Fargo, JP Morgan, seems like they'll probably be able to withstand the worst of it. But who knows, once a systemic collapse gets its feet under it and it starts running a series of bank runs, how vulnerable any of these banks could become. And this, of course, is a predictable result of all of the central planning and manipulation by the Federal Reserve. The fact that they kept interest rates so low for so long that so many of these banks took on this tremendous amount of leverage. They bought all of this government debt as a place to park all of this money. And now that the Fed has been cranking up rates, they're sitting on huge unrealized losses. Now, there's also the fact that these banks hold these bonds in two different portfolios. They have the ones that are available for sale. They also have ones that are called hold to maturity. So they go into a different category. And I'm not an expert on this by any means, but I believe it was back in the 2008 financial crisis that they relaxed the rules on banks having to mark all of their assets to market. So on their balance sheet, having to calculate the value of that asset as the current market price. Now, that is what they do. They mark to market the value of their available for sale bonds, but the ones that they hold in the hold to maturity bucket, they may have losses on those, unrealized losses, that they don't actually account for on their balance sheet because they don't have to mark those assets to market. They just put them down for their face value, what they're going to be able to collect in 10 years or 20 years or whenever those bonds mature. But that means that there's a huge amount of unrealized losses that could potentially be felt if these banks are forced to liquidate these assets. And so, what does this tell us about gold and silver? Well, look, SVB collapsing isn't going to destroy the economy or destroy markets, but should we see some kind of contagion spreading throughout the banking system, it's very likely that the Fed is going to get involved and intervene. And what they're going to have to decide between, they're going to be put in a hard place, and they've been in this hard place for a while. I mean, I've mentioned this before, but they will finally be forced to make the decision between, say, letting a large portion of US banks collapse and seeing depositors who have uninsured accounts, in excess of the FDIC limit, lose their deposits, and seeing tons of economic havoc play out, a real financial crisis, or they're going to have to pivot, which is something, we've been looking for a while. I've said countless times on these videos that eventually, in this massively over-leveraged environment that we find ourselves in, if the Fed keeps cranking up rates, something's going to break, and this could be it. This SVB thing could be the first domino to fall in the next financial crisis. And let's be real, even if this isn't what triggers it, it does reveal to us that there is tremendous risk within the system. And if the Fed pursues this policy of hiking rates, something else is going to break. The cracks are starting to show. But the problem between this intervention and the previous interventions, when the Fed slashed rates following the dot-com bubble, or when they slashed rates and began QE following the 2008 financial crisis, or when they slashed rates even more and did even more QE in 2020, the difference is that now, if they intervene, they will be intervening into already high inflation. And that means that inflation is going to get much worse. And I do believe that gold and silver's move on Friday is indicative of that risk. Markets are beginning to act a bit more rationally, and they're beginning to realize that the possibility of serious inflation is right around the corner. So the real question is, as we wrap up this weekend, will there be more consequences for the financial system in the coming week? Like, what are things going to look like on Monday morning? Is everything going to go back to normal? Or is there going to be more catastrophic risk introduced to this environment? Because if there is, if we hear hints of some kind of intervention or some behind the scenes action to prevent a collapse, that very well could send the dollar tanking. It could send gold and silver very much higher in a very short period of time. I think we saw a preview of how the precious metals will behave in a real financial crisis on Friday when we saw them rallying, contradicting this previous trend that we've seen where when we get high inflation numbers or we get good job numbers that we see the metals fall. Now, I think that paradigm may be over with this collapse of SVB. Even if SVB isn't the harbinger of the collapse of the entire financial system, something else will be. I mean, we are in an environment that is laden with black swan landmines that sooner or later we're going to step on. And really, it's all going to be about how the Fed responds. Will they let these institutions fail, or are they going to intervene? But either way, I want to be holding hard assets. If we see some kind of a systemic failure of the banking system, I am glad to have some assets that do not have counterparty risk or in my own custody and are completely outside of the system. And if the Fed intervenes and triggers a dollar collapse, then I absolutely want to be in hard assets even more, because even if all of the bank accounts are safe and everybody's going to get their money, that probably means that that money is not going to have the same purchasing power as pre-crisis. So Monday is really going to be an interesting day. And, I had kind of been waiting for a decline in the price of precious metals. Like I said, I thought that we might get one on Friday on those jobs numbers. But now I'm wondering if I should pull the trigger on doing some more stacking before Monday hits, because who knows? I mean, we could see the metals take off if this crisis really turns out to be worse than we have originally anticipated. And one final thing that I'll leave you with is that just because the financial media says that everything is okay, that's not necessarily the case. I think it was on February 8th, sometime at the beginning of February, Jim Cramer was talking about SVB, and he told his viewers that they should buy it, that the risk of collapse and that the rumors were overblown, and that he thought it was a great value. And it wasn't just Jim Cramer. I mean, I know he kind of has a reputation as a contrarian indicator. It was also Forbes published their list of the best banks of 2023, and SVB was number 20 on their list. So, I mean, it wasn't in the top position, but still, that's kind of scary that nobody really seemed to see this coming. And yet we know that many of the banks out there have similar vulnerabilities to SVB. So leave me a comment down below to let me know how you think this is going to play out. What do you think the markets are going to do on Monday when everything reopens? And it's kind of curious that this stuff always seems to happen on a Friday, right? When you can't really do anything about it. It's going to be an interesting week, folks. And if you don't have any gold or silver, if you don't have any precious metals, hard assets outside of the banking system, I don't give financial advice on this channel, but it might be a good time to consider getting some, because there may come a time in the near future when you just can't place an order online anymore, and nobody wants to sell this stuff for devalued currency. So anyway, thanks for watching, everybody. Hope you have a great weekend. Get some rest, because this week is going to be an interesting one. Stay safe and happy stacking, everybody. I'll catch you next time. Smart Silver Stacker, out.